Hello, everyone, and welcome to today's webinar. It is May 24th, and today we are presenting Home Ownership, Understanding the Housing Market, presented by Marie Bonville. My name is Alyssa Atkins, and I am the Training and Development Coordinator for the Native Learning Center, and today I will be your webinar facilitator. This webinar provides a summary of fundamental concepts, requirements, and/or procedures within the allotted 90 minutes. The material discussed does not illustrate all possible scenarios that could be applicable, and today's webinar is being recorded. Before we get started, I wanted to familiarize you with some of the features available and how the environment works. If you look at the top of your screen, you will see an icon of either a person with their hand raised or just a hand with that icon. You can either raise hand, agree, disagree, or step away. Now your screen should look similar to this graphic here. To the bottom left, you will see a box that says Files. Here you will find today's presentation. Please feel free to download a copy for yourself. Simply click the item you would like to download, then click the arrow pointing downwards, and you will be prompted to save or print the materials based on your device's permissions. The second box that states Web Links to houses today's survey, as well as any other links that are found throughout the presentation. Lastly, to the right of the screen, we have a chat box available. This is how you will communicate to the instructor and NLC staff. If you have any questions during the presentation, please feel free to interact by using the chat box. Simply type your message and hit enter to click that up arrow icon button to submit. All tech support issues should also be submitted here. Oops. It is now with a great pleasure that I introduce Marie. I'm going to go ahead and switch it over to you.
Awesome. Thank you very much. I really appreciate your assistance with today's webinar for sure. And I want to thank the Native Learning Center for inviting me back. I'm not entirely sure, are we on my presentation or are we on
We are on your presentation.
Okay, perfect. So hopefully everyone can see my screen. I am Marie Dufour Bonville, and I started with the Seminole Tribe of Florida way back when. I won't give you a year, but I've held several positions there. I'm probably the most proud of Director of Training and Technical Assistance for the Native Learning Center because I learned so much about not just Native housing, but housing in general. It was just such a great opportunity for me, and so I do appreciate everything that I've learned in my time there. As owner of Sunlight Armor Homes, LLC, and Sunlight Armor Realty Group, LLC, I provide both construction and remodeling, education, and training. My husband is a general contractor. I also provide both the services of purchasing and selling a home here in the state of Georgia, where I'm licensed. However, I never stopped working with Native communities. I thought that was going to happen when I moved, but essentially the ability to work with communities and coalitions like the South Dakota Native Homeownership Coalition and Enterprise Community Partners, and working with the Native Learning Center, it's just continued to be a lifelong blessing for me. I have a bachelor's in political science and a master's in public administration. Community development is a passion of mine, and so I'm very thankful to continue to do the work that I do. I'm a wife and a mother of two, and I do reside in Georgia. So that's a little bit about me. Now let's get on with this. We have so much to talk about. So to start with, the real estate industry and the housing market itself plays an essential role in the U.S. economy and in our smaller economies, within our reservations and even in native urban settings, right? So this webinar is going to give you a greater understanding of how the market reacts to things like low inventory, building costs, right? In 2020, who couldn't say what lumber was going to be within any given week, right? Interest rate changes, we're experiencing that as of today. We're experiencing that exact response. And then buyer and seller demand, right? Most of our buyers will say that they need a home. And in our communities, we know people need home ownership. So it's not so much, we don't always see the behaviors that buyers and sellers demonstrate on the reservation or off the reservation. But I do think that it's important to understand how motivation works. And so even your most prepared buyers may not want to purchase a home right now because they're seeing interest rates and they know what that means for them in terms of their payments. And then lastly, we'll talk about how best to prepare our home buyers and sellers. I know many of us are working with no income, low income communities, but then also we have this element of individuals who are utilizing Section 184, that have higher income limits, and they need to know how best to navigate the home buying process. So we have to talk about the Great Recession. I think when you look at the history of housing, you'll see that the Great Recession of 2008 has a huge impact on what we're experiencing today. So we kind of have to talk about that, and also the history of housing in general. We'll talk about interest rates and how they influence behavior, as I mentioned. And then lastly, supply and demand. That is one of the basics of economics and of a market, is the idea of supply and demand. So we kind of have to talk about that in different ways. So the first thing is the past. Most of us aren't really familiar with exactly when the housing market started, but we should know how it's impacted Native communities. And so the housing market boom in 1950 and 60, typically when you see it in history books, it's mostly white Americans of the baby boomer generation coming to age, right? They're in that 25 to 35 range, and they're looking to buy a home. And so that's when you kind of see the American dream formed. And then the housing market continues to see several harming housing practices that had a huge effect on minority communities, specifically Native American communities. In that, if you're on reservation, the complicated process of allotment or trust lands makes it an impediment to housing. So let's talk about redlining. In the 1930s, the Homeowners Loan Corporation, they created a system of maps, and these maps were what banks used to decide on loans, right? The perceived risk of lending. These maps identify communities of color as either hazardous or that the value isn't there, right? It's depreciated. And this means that it makes it difficult for people to get loans. So here you can see a red line map, and NCRC, the National Community Reinvestment Coalition, they put out a study that shows that neighborhoods today are more likely to, if they were redlined in the past, then they have higher poverty rates, low, right, as far as income rates, lower home ownership rates, the median income, as I said, and then this is in comparison to non-redlined neighborhoods. So there's a huge financial impact. The Federal Reserve Bank of Chicago found that children who grow up in currently in those redline neighborhoods of the past are more likely to suffer from asthma, obesity, and other health problems. Why is that, right? So housing has a huge impact on infrastructure, on community services, on healthcare. And so there's a huge connection between the redline communities of the past and what we see today. So let's look at it from a couple different lenses, right? I wear glasses, so let's put on another pair of glasses. Blockbusting, what's that? So it's not just the banks. A lot of people think of redlining, they think of banks, but what about the other professionals, real estate professionals? So real estate agents often encourage white homeowners to sell their homes in neighborhoods by making them believe that minority families are moving in. Think of if you're old enough to remember All in the Family, or if you're not old enough, Google it. But the idea that there's a community changing, right? There's a white family and then the community's changing around them. And, so the real estate agents of that time frame would say, what, it's time to get out, move. In the case of South Florida, you see the move from South Florida to West Palm Beach, St. Port Lucie, North Florida. And that we consider that down in South Florida area, the Great White Flight. This is because they were being prompted by their real estate agents to sell. This prompting is considered a panic sale, right? You're not doing it of your own accord. You're kind of feeling like you need to sell, and it doesn't matter what the cost associated with that looks like. And so this drives down property values in these areas. The other pair of glasses I want you to put on has to do with the political lens, right? So if electoral districts the boundaries of them are made so that your representatives have an unfair advantage, then that means you have concentrated minority votes, right? You have single districts where it makes it really hard for people to collectively represent your interests, right? So economically, there were a lot of districts that were gerrymandered to the point where it was concentrated. You only had one representative, and so you can collectively make headway. When you think about being appointed to certain committees, typically the majority the majority is in charge is responsible for adding you to certain important committees like Ways and Means. So you can imagine from the purse strings perspective, you're just not getting the impact that you need for your community because of gerrymandering. Okay, so now we want to talk about workforce disruption. And this was huge in the Native community in the 50s and 60s, so it's important to bring it up. Here you see an image and it says, "Come to Denver, the chance of a lifetime." And it promises good jobs, happy homes, and training, right? The Indian Relocation Act of 1956 was designed as a federal law designed to remove Native Americans from the reservations and set them into urban areas in Denver, Chicago, etc. So the goal was to assimilate. However, they said that there would be some sort of financial assistance, and that's usually a one-way bus ticket, a small stipend, and vocational school, depending on the job selected, right? Here's what they found. From 1950 to 1968, more than 200,000 Native Americans moved to cities, terminating the tribal status of many Native communities throughout the country. In addition to that, these weren't what were promised. These weren't high-paying jobs. These were low-paying jobs with little advancement potential. To make matters worse, you've got racial discrimination going on, and then you also have the inequality that's being faced within the minority communities, right? Because now you've got just another group coming in, and so that created all sorts of discord amongst these communities. Housing and job discrimination persisted, but then sadder still, and this is the part that gets me the most, is that you've got all of these issues, right? When you first arrive, and then on top of that, you've got cultural and social isolation, right? Not only do you not have your community to support you in those elements, but you also don't have a way to come back, right? So if there's any sort of, if for whatever reason it was terminated, you no longer have a place to go back to. And a lot of folks felt they couldn't go back after having left their families. So what impact does this have on the reservation from a workforce perspective? Remember, put these glasses on because we're going to need them throughout this presentation. Investment in the community, population growth and infrastructure, that's a huge decline, and then policies. So when you're looking at housing market, you have to look at building blocks to creating this market. It doesn't just happen overnight. Local businesses, right? They're the ones that produce goods and services. In the case of many communities, it's the tribal government that's got the highest number of employees. But they're producing services that are meeting the needs. Those individuals are making a paycheck. But hopefully there's enough investment to create a workforce, right? You earn money through employment, and so that workforce is what was removed. Money spent by community members at these businesses, they support operations, right? Community needs to have investment, and that's in your education, right? The school system, you need to have roads. And so all of this is starting to build up your economy. The circulation of money contributes to population growth, right? When people are happy, what does that mean? Babies. It means infrastructure. You now need roads to connect to different places. You need tax incentives to businesses to have businesses come to the reservation or come near or around the reservation, right? And all of that was the kind of thing that helps to build your housing market. Off-reservation housing market. This is the very last element that I think we should discuss here. Is when you're buying land off the reservation, it's so simple they even call it that. It's fee simple, right? It means that the transfer of ownership from one person to another it's fairly simple. In the tribal allotment or land trust, tribal allotment, or if you're on trust lands, it's a lot different. You need to have the BIA involved and go through a title status report. Think 50s and 60s. This is taking much longer than it does today. So, purchasing a home on the reservation is just a cumbersome process at this time. So the Housing Act of 1937, these are the HUD homes that you see all across the country. This was their way of addressing, homelessness and the need for housing on reservations was to put these HUD homes all over the country. If you're familiar with Levittown and those little square 1,400 square foot houses, there's these little boxes all over the country, right? But they miss the mark. These homes are culturally insignificant. And then, of course, We see them all across the country, regardless of climate, and so they didn't last very long. Although we're still trying to maintain these houses today in some communities. So native housing and banking, as I mentioned before, we saw how those negative policies affected the communities back then. But then even today, we see that according to the U.S. Census Bureau, homeownership rates are 52.1% in Native and Alaska Native communities. However, that's significantly lower than our national homeownership rate of 65.5, right? So you can see the huge difference there. According to the 2017 study by the FDIC, 42% of Native American households had a bank account. This is lower than the national average of 70%. So why is that? There's a distrust there, a disconnect between banking and banking services. Banks didn't come in or around or near the reservation. And so a lot of times individuals are having to use alternative sources, check cashing services, payday loans, and things like that, in terms of financial instruments. So when we're looking at how you purchase a home today, surely that you need to have, it's so much easier when the individual is banked and they have their checking and their savings account and their financial wellness element is intact. And in many parts of our communities, that's just not the case, and that's systemic. So let's talk about generational wealth. It's a catchphrase, people use it a lot, but how do you create it? So according to the 2021 study by the Urban Institute, real estate accounts for 70% of all generational wealth. Let's pause there. If real estate is 70% of generational wealth, and communities of color had a huge impediment to getting housing, then you can see that some of the issues that we face today are a direct result of housing. So understanding the housing market, super, super important. I was talking to someone earlier, and I was talking about the fact that I was in housing, working with Native communities. We talk about saving and spending and building credit, but we don't necessarily talk about housing and the market itself. And I think that we should. So this is a great opportunity to be able to talk about this today, because I think it's going to be helpful as we explain the why to folks. It's not just about the house itself, but it's what it represents. So generational wealth, this means that for most families, their home is their asset. We don't look at homes as a financial an instrument in Native communities. It's so much more than that for us. So it's important to understand that. How real estate builds generational wealth. Well, how does it happen? I get that it's 70%, but it's through tax breaks, right? So homeowners can deduct mortgage interest and property taxes if they're off reservation from their federal income taxes. And that's a huge savings to them. So there's tax breaks. Increased borrowing power. So I like to think of homeownership as when you make your mortgage payment, you have a pair of jeans on, you got two pockets. And every time you make a payment in one pocket, yeah, you're paying interest, right? It's the cost of borrowing money. The bank's not doing it for free. They have a fee, and that fee is interest. And so, yeah, some of that money is going in from your payment is going into one pocket. But then you have a whole nother pocket on the other side. And that is where your equity on your house is growing, right? You're paying yourself each month. That's another great way of describing it to our communities, is saying this is you paying yourself each month. And so your equity grows on your home over time, right? What we mean by generational wealth is that if a family member wants to build, right, a son, a daughter, a cousin, an aunt, they want to build their future, right, and buy a home. Oftentimes, parents pull out home equity loans. Parents pull out or sell their home, and then that money that they gain, that they have saved in that pocket, can go towards another family member. So that's generational wealth. And so this increased borrowing power is huge. Increased savings. So on average, homeowners are more likely to save money because they have a vested interest in maintaining this home, right? It belongs to them and they need to prepare it. I know in Native communities, you hear a lot, of the staff talk about how, they're moving from tribal house, the TDHE helping them and with property management and whatnot. And when they transition from renting to owning, they have a huge misunderstanding as to who pays for what when there's a repair that's needed, right, on the house. So why is that? That's because they're not necessarily familiar with the idea of having to save to fix things. And homeowners in general are more likely to save because they know the water heater might go out. I might need a new roof come next year. My insurance might go up. It's another element that folks may not be familiar with if they're renting. And then lastly, financial security. On the reservation, most of the individuals who are purchasing homes have lived on the reservation, will continue to live on the reservation for a very long period of time. So there's this idea of stability. They know exactly what their payments are going to be each month. That can be really hard to do when you're renting, right? If you're renting each month, each lease year, or maybe it's every 2 years. If you're in a native or urban native setting, then for sure your rents are going to go up. And when they do, you may not be able to afford it. So we also have to talk about gentrification, because as of 2013, it's such a prevalent experience. It's no longer affordable to live in certain communities, where people had relocated to. For example, Denver, it's very expensive to live in Denver. And so why is that? Well, remember, they were red line districts. And so oftentimes these are close to the downtowns. They're close to amenities, transportation, venues, right? A lot of the major sports complexes are in or around these cities. And it makes them attractive to people who have money. And it's convenient, right? The commute to wherever they work is pretty convenient reason to move there. Lower property values, right? So the other thing is, going back to red line districts, is at the time they were lower in value. So if you've got money, it's a good investment. And then lastly, of course, diverse populations. And that's just the fact of being in a city center. You have all the different cultures. And for a lot of, I think, especially the younger generations, being in a diverse environment is something that they value. And that's another reason to be in the community. I don't think they go out of their way to gentrify these areas. But as you can see, it's just the natural progression of where we are based on the way the policies were set up in the past. So now we have to talk about the terms and conditions, right? There's always a catch. So let's talk about the housing market from that perspective. Let's talk about the terms. The things you need to know are supply, demand, inflation, interest rates. Those are very important elements. But then there's also credit, right, in the housing market, down payment in the housing market, closing costs in the housing market. So we have to talk about these things as well. Real quick, I'm going to pause and just check to see if there's any questions in the chat area. I don't see any.
No, not any yet, Marie.
Okay, great. So let's go back to, sorry. Okay, so let's start with supply. The housing market supply itself refers to the total number of available homes or properties in any given area. And this is either for sale. There is data on the rental community as well. But for the purpose of this presentation, we're going to talk mostly about the housing market supply in regards to the sale of a home, right? So it's how many houses are actually available. If it was 2020, you can imagine most folks were like, I don't know what's going on. I think I'm just going to stay in my home, right? Most people didn't move. So supply is pretty low just because of the dynamic of the pandemic. It represents the quantity of housing units in any given market that's ready for people to move into. Demand is a different element, different beast. With demand, how the housing market is influenced by a couple things. As I mentioned before, population growth and changes, income levels, employment opportunities, right? Interest rates, of course. Interest is the cost of borrowing money, right? The banks are doing it for the warm and fuzzy feelings. They're doing it for a profit. And so interest rates oftentimes affect affordability, right? The ability for our folks to afford a home. So demand, they may say, wait a minute, I don't know if I want to purchase a home right now, and maybe too expensive. And then lifestyle, of course, there's every type of home on the market, but the lifestyle that you want to lead, whether that's in a rural community or a setting versus being in the city, is going to cost you an amount. So why supply matters is that it has a dynamic of changing the relationship that people have towards buying and selling. So if when supply is high, or excuse me, when supply is low, then it's usually considered a seller's market. Why? There's not a lot of houses on the market. The sellers can be more selective, can say, hey, there's 15 people that want my house, and then I can choose one. It typically drives the prices up higher. So there's limited options for potential buyers, and so it increases that competition and higher prices. What about when supply is high, right? When there's a lot of houses on the market? This is usually considered a buyer's market. This means that in this scenario, you have so many to choose from as a buyer that you no longer have to necessarily pay as much. So it typically means lower prices and other incentives, right? If you are in a buyer's market, the sellers may say, well, shoot, I want you to buy my house. And I see that you're shopping. I will pay for half of the closing costs, right? Which is the cost of buying the home, right? There are closing costs involved. I'll give you half. I'll give you I'll provide you with repairs. That's another incentive. So it's not just necessarily the cost of the home itself. I know that's what most people think, but there's these other incentives that sellers can also provide or negotiate. And so it's a really interesting dynamic. Also, you have more buying power, right? Your money's going to move further in that type of environment. So let's talk about inflation. We're currently in an inflationary experience. And what does it mean? So inflation defines a relationship between the price of goods and services and whether or not it's rising over time. So what do I mean by that? So there's a basket of goods and services. And so think about it on the reservation. There's this basket and it has certain goods and certain services. And I take a snapshot, I take a financial picture of what that looks like at January 1st. And then on July 1st, I look at it again and I say, wow, this basket now costs $15 more. What does that mean, right? What's that change in over time? Inflation so if that same amount of money buys fewer things, then inflation has occurred. And it's usually in terms of percentage increases, it's a percentage. And then inflation erodes the value of your dollar, right? It just means that there's so much money in the market that now my dollar no longer is at the same value. It's taking me more. It costs me more to purchase the same set of goods. Think about for those individuals who purchased cars, 2-3 years ago. You have a $60,000 car and your car payment is $600. With the cost of inflation, that car may cost so much more now. Between that and interest, it may not be a financially sound decision to move forward with purchasing a car today. So it just does that. That's the relationship there. When inflation occurs, prices of goods, they increase. I don't know how many of you have heard of all the different memes that are about eggs, but it's exactly that, right? Eggs used to cost maybe $1.99, $2, and now it's $6, $7, $8, right? So it's the cost of your everyday goods that are increasing. And this is also going to contribute to, the supply and demand, the behavior itself that people will have. They'll say, well, what should I do here? And I'll take a pause. I know for me, my grocery habits completely changed when inflation started to rise. So let's talk about the good, the bad, and the Federal Reserve, right? So mild inflation is generally considered, it's a part of life. It's not that inflation doesn't occur throughout the healthy or growth periods of the economy, right? That exists, but high inflation, right? That has a different effect. Your buying power is now lessened, right? Your savings what's in your savings account now means less to you. If you're looking at your 401k, you're kind of like, okay, if I take money out now, the value isn't there as much. The Federal Reserve is the central bank of the US, and they're the ones that are in charge of this policy of controlling how much money is in the market. And they do it by several different financial instruments. It's not just by adjusting interest rates, but for the purpose of this presentation, we're not going to talk about bonds and all these other things. We're going to talk specifically about interest rates. That's one of the tools that they use to either put money into the economy or take money out of the economy. And this is how they create, or they help to create, a sustainable economic picture, right? And that it's not always the case. There's going to be lots of individuals who are either for or against the Fed from a political perspective, but it's important to understand that their role. So they control interest rates and they influence this rate. Each time that they meet, they can choose to adjust the interest rate or leave it where it is. And also too, it's important to note that whenever you see on or hear that the Fed is adjusting the interest rate, it takes time for the housing market to respond to that. It doesn't happen overnight. You might see car loans, credit cards, personal credit, that those types of things tend to be more responsive to this change. With mortgage rates, it takes a little more time for it to catch up with the rest of the market. But let's talk a little bit about personal credit. How does that affect the housing market? Well, one, eligibility, right? If borrowers have more debt, then how many of them can afford a home and or get approved for a home? So of course they have to review their credit history, credit score, credit worthiness, and if that's a problem, then the housing market has a problem. Interest rates. If interest rates are higher because they have bad credit, for example, then they're going to pay more for that home each month. I think I read that a home purchased in 2018, that payment might have been $1,500. Today, that same home, that payment would be double that, so $3,000. So it just goes to show you that how interest rates can change the payment amount and make a home unaffordable. So the next thing about personal credit that I want to mention is the fact that I talked about affordability and how a higher credit score and better credit can lead to more favorable terms, right? Those lower interest rates, and then also lower monthly payments. But I did want to mention the fact that, talking about the down payment itself of a home, that is a huge element to home ownership, right? Is that you have to have money for your down payment. We talked about the fact that in most of our Native communities, generational wealth isn't there. So down payment help or assistance usually comes from the tribe. So if you're saving money, that's great. We want people doing that. But in terms of more favorable rates, you would love to have a low down payment for your borrowers, right? And so when you have better credit, typically you put down less money. So that's that about down payment. Let's talk about closing costs. People always get this one confused in terms of they like to think that down payment is a part of closing costs, in that it's this other element of money that you need in order to close on the home, but it is not the closing cost itself. Closing costs is a totally different beast, and it varies on location, property type, and the transaction details. So you have fees, right? These fees include the loan origination fee itself. So the bank has application fees, appraisal fees, mortgage points if you're trying to buy down your mortgage, the interest rate, title related fees, right? So let's think off reservation for a minute and think about the title search, the title insurance, the recording of the document itself through the county, attorney and closing agent fees. So depending on where you live, depending on the real estate transaction, rules and regulations within each state, you might have an attorney, or you might have, in New York, for example, you'll have an attorney who does this. But in Georgia, you have just a title company that will assist with the closing itself, and they have fees. Inspection fees. This is typically a buyer fee that or buyer paid fee that you'll see in closing costs, in that they have to get the home inspected prior to moving forward with the contract. Property taxes and insurance, again, off reservation. You'll have that property taxes element on reservation, or off. You'll have insurance. So that is a non-negotiable, whether you are on or off. Insurance is a requirement by the lending institution. And so insurance premiums are due at closing for that particular year. So you're always paying it in for the year prior to. Escrow, this is an element that a lot of our individuals aren't familiar with, but this is money that's being set aside for the purpose of this is going to go towards your down payment, right? Will be held in escrow, and sometimes there's fees associated with that. And then if you're and I've actually seen with new community developments on reservation that there's HOA fees. So we're talking about it a lot more than we used to. But essentially, when you're part of a community development plan that has, shared amenities, right? A pool, a park, shared roads, lights. Maybe everybody has to have the same mailbox, things like that. When you're trying to keep the value of the area or the neighborhood that you're buying in, and you're wanting to maintain it, when you want an organization to confirm what can be on your home and what can't, right? What colors, what materials can be used, when you build the home. All those things are kind of encompassed in a homeownership association, someone that kind of another layer to this process. And they have fees. Typically, if you've got a pool in a park, it's going to cost you anywhere between $250 and $750 a month, in addition to maybe there's security, right? And other amenities. There's reasons for homeownership associations. There's benefits to that in that it maintains property value. But it's something that we're seeing more and more. So let's talk about the housing market and the Great Recession, right? How and why, and where did it come from? So, we talked a little bit before, but there's this huge expansion in the 1960s of both the mortgage market and the suburban areas, right, outside of the city. And so the demand for housing construction, increases. You've got, you've got FHA and the VA that are putting out the loans for our returning GIs. Our returning veterans and the GI Bill. To remedy the policies of redlining and gerrymandering and some of the other things, as far as the discrimination in housing, they went ahead and enacted the Fair Housing Act of 1968. And when Congress did that, it was to prevent discrimination in housing based on race, color, religion, national origin. There are protected classes, and so it's really important, if you're not familiar with fair housing, that you get familiar with it, because it's very important in terms of how industry professionals like myself have to respond to individuals, and not discriminate, right? So the Fair Housing Act itself, is something that I have to comply with, and then I or face, the relinquishment of my license or huge fines. I mean, the fines, in regards to fair housing are huge. The most recent fair housing court case that I saw was in regards to appraisals, right? The value of a home. There was a minority family. They had their appraisal. They felt it was low on the home. They were selling the home, and they got an appraisal, and they thought it was very low for the area. They removed the pictures from the home of their family, and they decided to change those pictures with a white family, and they saw a huge, and then they actually had to pay for another appraiser to come out. And when they did, they saw that the value of the home was much higher, and they were able to sue for damages in relation to the Fair Housing Act and the fact that the appraiser didn't comply with fair housing. So the average U.S. housing timeline starts with this expansion, as I mentioned before. And then in the 70s, if you were old enough to experience it, then you know that you had high gas prices, energy costs were high, inflation was high. So of course, this creates challenges, but there's this perception of the American dream that's still out there, and it's working, right? The CRA, the Community Reinvestment Act, if you're familiar with money being pumped into communities to fight this inflation, what they went ahead and did was, or revitalize these areas, is to go ahead and say, well, we'll put money in the communities so that we can access more housing. In the 1980s, home ownership rate still remained stable. It ranged anywhere between 63 and 65%. Interest rates were super high, though, and this is because inflation was high. So the average 30-year fixed mortgage in 1980 was around 18%. That's huge. Home prices experienced moderate growth during the 1980s. According to the Case-Shiller Home Price Index, this is an organization that puts this information out yearly, says that the prices over time averaged around 7%, like the change in how much equity someone's getting in their home. In the 1990s, you see that there's still, growth in home ownership. The 30-year fixed mortgage rate, it declined, it went down, so that's good, to 10%. Home prices experienced moderate to strong growth in the 90s, even with the dot-com bubble bust. So, in Native communities, taking that U.S. lens and bringing it down to our Native communities, building homes and increasing capacity, what happens in the 90s is super important in terms of the ability to say that we want to have control over our home ownership needs. So the first thing that we saw was Section 184 in 1992, and this allows for a loan guarantee program in which the banks now can feel more comfortable borrowing on Native, on trust lands. The loan guarantees assures the lender that if the investment isn't repaid, that it will be repaid in full in the event of foreclosure. So the benefits of Section 184 is that there's no income limits. So that's the first thing. In many of our communities, as I said before, we're focused on our low and no income, members. But then we also have, what about our service members, those individuals that are providing safety, right? Our police officers, our teachers, they are often not able to apply to a lot of the affordable housing units that we have. So how can we assist them? No income limits is one way of doing that. Interest rates. They're based on the market rate and not an applicant's credit score. So typically, your interest rates are higher if your credit score is lower. Your interest rates are lower if your credit score is higher. So that's that relationship there. Under Section 184, your debts can be higher than the national average. So for a conventional loan, your debt can't exceed 41%. Tomorrow, we're going to have a talk about the home buying process, and we'll talk a lot more about debt to income. But that's that percentage. In the conventional market, you're looking at 36 to 38%, and then for Section 184, it can be higher. Down payment, this one's huge. So typically, you're putting anywhere between 3.5% and 20% down. In the case of Section 184, borrowers only have to put 2.25% down for the loan if it's over $50,000. If it's under $50,000, the payment is only 1.25%. The borrow applies through any lender that's approved to provide Section 184, and then they work with the tribe and the BIA, in terms of the leasing of the tribal land. And the lender evaluates the loan documents and submits everything with manual underwriting. That's huge. Typically the conventional home loan process is done automatically through, I won't say AI, but it's done through a computer-based system. And in the case of Section 184, there's an actual person evaluating credit history and the credit itself. So then NAHASDA comes out, and this is huge because this is the Native American Housing and Self-Determination Act, and it's in the title that we can now determine what type of housing is best needed for our communities. They're given an Indian housing block grant, and these funds, and then Title VI, that is another loan guarantee program that helps tribes expand home ownership opportunities or rental opportunities with their community. So according to Enterprise Community Partners, since 1996, tribes developed over 40,000 home ownership opportunities and 25,000 rental homes for families in their communities. Now, the great thing about NAHASDA is that it can be leveraged with other elements. Think low-income housing tax credit, think state and other federal programming that can also increase home ownership and the ability for affordable home ownership on the reservation and off. Let's see, time-wise, I want to make sure I have enough time for everything. The Great Recession. So 1997 to 2001, there's a rapid growth, rising home prices, low interest rates, relaxed lending standards. What do I mean by relaxed? No income, meaning you don't have to show proof that you are employed. You don't have to show proof that there's certain documentation that you no longer need. So relaxed lending standards, that's a big one. And then there's this increased demand for housing. 1999, this further deregulates financial instruments, right? How banks and investment firms and insurance companies can package loans, right? There's I don't want to go too far into it, but there's a first market, there's a secondary market for housing loans itself. And so this transaction on the back end within the banking industry is something that's starting to get relaxed in the early 1990s, or excuse me, late 1990s into the 2000s. So because of that, right, the money's flowing, you've got a significant boom. Housing construction increases. And then there's this thing called subprime lending. What does that mean, subprime? It just means these are less than lackluster loans. Think about loans in terms of letters. A, great credit, great job, approved. B, decent credit, not the best, but not the worst. And that's your B lending. And then C, right? Not great lending. We don't know, with no income, stated income, meaning the person just said what they made. There was no verification of employment. Maybe there's an ARM, meaning that this isn't a fixed rate mortgage, but something where it's going to be low at first and it's going to grow over time in terms of the payment. So the payment's not stable, right? That's what we mean by subprime. Many homeowners take advantage of this. They think, wow, I don't need to have all this proof. This is great. They don't know much about the housing market and they don't care. They just need a home. They think it's a good idea and they decide to purchase a home without knowing the specifics. 2001, there's a little bit of a bubble burst there with the .com, right? Everybody thought the internet was going to be this amazing thing. But everything has a time to cool off. And in this case, the .com bubble burst in 2001. 2004, there's even more relaxing of regulation, and that's in terms of investment banks. So you can increase your risk and take on more and more risk over time, which is what the banks did. Home prices, 2005, 2006, they start to slow down a little bit because we're starting to see people miss mortgage payments. If you have a fixed mortgage payment, your payment doesn't change over time. But if you over that 30 years, it's not going to change unless your insurance goes up or something like that. But in most cases, it stays pretty much flat. Delinquency rates on subprime mortgages begin to rise. What does that mean? That means the ARMs are starting to move, right? Your ARM went from $2,000 a month to $6,000 a month because you didn't really understand the terms and conditions of an ARM. 2006, now they're starting to show cracks. There's a larger number of subprime mortgagors, and now they're filing for bankruptcy, right? And they're closing their doors. 2007, August of 2007, the housing bubble bursts as subprime mortgages continues to spread and the number of foreclosures increase. Home prices decline. No brainer there. These people can't afford these homes to begin with. The house prices were inflated because there were so many people purchasing them all at one time that the market experiences this huge downturn. By 2008, the housing market crisis intensifies, and now we've got a global financial problem, and it's considered the Great Recession. Major financial institutions think, what's the big one? Gosh, it's going to come to me. It starts in the housing industry and then it goes into auto industry. But all of the big banks were responsible for this situation that occurred. They took advantage of the relaxed regulatory environment, and this was the end result. And so there was this big argument between Main Street and Wall Street, and why should we bail them out? And how is that fair? And so I put this political cartoon, in terms of affordable housing, and then you can see the economy kind of swishing back and forth because there was a lot that we didn't know. Personally, to make matters worse, I'm very intimately connected to the 2008 Great Recession because I purchased a home. I purchased a home August of 2007. And by August of 2008, I had lost roughly, I purchased the home for $375,000. And by August of 2008, it was worth $190,000. So I was what you call underwater. So how did they stabilize the economy? Like what happened? And then on top of it, 2008 is a election year. So there was a lot going on. But how do you stabilize the economy? What do you do? Well, from a bank perspective, right? From Wall Street's perspective, you have to create the TARP, which is the ability for the Treasury to buy up some of this assets and stabilize this system. So those are these acts here, everything you see here. Real quick, I want to talk about Fannie and Freddie. These are the secondary market group. These groups had to have much more oversight as to how and they could assist the borrowers that were struggling. I mean, people were losing their homes. Main Street. So the main one that I want to talk about is Dodd-Frank, because this is where you see tomorrow when we talk about home buying, the process itself, you're going to see a loan estimate and a closing disclosure. And these are as a direct result from Dodd-Frank and the Consumer Protection Act, which basically says people have to understand what they're buying. There's a term, gosh, what's it called? Where when you purchase a home, there's no refund, there's no returns on a home. Once you purchase the process, it's buyer beware. And so you have to make sure you know ahead of time what this thing is going to cost you in terms of your interest rate itself, right? The fees that are associated. So we're going to talk tomorrow about the closing disclosure and how important it is that buyers understand it. But this is a direct result of the Dodd-Frank Consumer Protection Act. I had to take advantage of making homes affordable. So this other program here, my arm adjusted and I couldn't make those mortgage payments. My husband and I didn't know what to do. And there were a lot of shady people out there claiming to want to help people. And then, they ended up not, as far as loan modifications and things like that, people couldn't go to the bank because the banks weren't answering their phones. It was a nightmare experience, if I'm honest. But I do think that when you're underwater, you just don't know what to do next. From 2007 to 2009, U.S. households lost over $7 trillion in home equity. Think about that pocket I was talking about where you're putting money into your home. Well, what happens when the home is no longer worth what you paid for it? Well, then now that money's not in your pocket. So this loss of equity was really hard for low-income communities, minority communities, and the impact was huge. By December, so as far as the official dates, December 2007 was the start of the Great Recession and it ended June of 2009. Therefore, the recession lasted a duration of 18 months. Over those months, there were a lot of things that we could highlight, right? National unemployment rate was huge, 5%. The banking industry much higher. So it was 5% in 2007. It was and it was 10% by 2009, October of 2009. Massive layoffs. Goldman Sachs, that's the one I was looking for. Them and other financial in the industry itself, had massive layoffs. In general, the economy saw 326,000 jobs lost. So tons of information. The PowerPoint itself will be available after the presentation, so you can peruse through all the different ways that the Great Recession had an effect on the economy itself and then on the housing market specifically. Mortgage delinquencies, right? We talked about subprime and how unhealthy those mortgages were. And so as far as the default rate, you can see that it's much higher than your fixed rate mortgages. So home prices, again, we're talking about 2009 and $180,000. Today, by 2023, the median home price has increased to $428,000. that's huge, right? So we've had some time between then and now. So it's really important to understand that this is a 146% increase. The pandemic and the housing market is another, shot in time that we need to talk about, picture in time that we need to talk about. Um, so here you can see in this graph the median home price, and this is when they say median home price NSA, that just means that it's not adjusted for inflation. So, for example, here you've got, and then CPI is a different community group in terms of how they collect their data and what they choose to include in it. So you can see here that we're at that 400. In some models, it says 450, but yeah, you're in that 400 mark right now on a national average. And why is that? Because the pandemic had low interest rates. Also low inventory. As I said before, people were like, wait a minute, I don't know what's going on with the economy. I'm not moving. And then you had a strong economy at that in terms of prior to the pandemic, you had, economic growth, wealth. Think about what happened with savings, right? We saw a huge amount of people saving their stimulus monies. Money was being put into the economy to help stabilize, service level positions where you had to have lots of contact with individuals. This idea of essential workers. But there's also an affordability situation as well, right? Because now these prices are so high, who can afford them is the argument. Low-income housing communities and the impact on mobility, right? If you're not able to purchase a home in your location, you're having to move even further away to where you maybe live or work or where family is going to be available to you. In tribal communities, of course, you have IHBG, ICDBG, low-income housing tax credit, other ways of trying to increase the supply for housing, but it was low to begin with, right? So this is an uphill battle that now the pandemic only increases. Systemic issues like overcrowding in our communities. So the supply of housing was already low, and of course, we needed to increase the amount of housing to try to address these things. Also, to protecting renters from housing prices and when those rise, right? So when in the case of where I live now, there were a lot of single family homes for rent. Individuals, private owners would say, okay, I want to rent my house and move somewhere else. And that's what they would do. When home prices rose, they decided to sell that house and now it's not available to them. Well, what happens when you have a community that doesn't value rental units, right? They don't have many apartment complexes. Well, then now these people have nowhere to go. Currently fighting inflation. So let's go back to the Fed. In March of 2022, the Fed increased increased the interest rates. And I have to go back to 2020 and the pandemic to explain that interest rates were very low, and they did that on purpose. They cut interest rates to under 2%, and that was to make sure that we could have money flowing in the economy during the pandemic. The drawback to that is that then inflation grew higher and higher. Now, by them raising interest rates, they think that it'll bring cool the economy and bring us back down to inflation rate of 2%. So there's two schools of thought on that, in terms of how much whether they should. So there's in an economy, there's this basic rule of laissez-faire, right? Keep your hands off of it and let the economy do what it does, right? Then there's the idea that the government should be involved in manipulating the market so that we have favorable outcomes. So I'm not for or against either one of those concepts. I just want you to know that they exist. And for the purpose of this presentation, I want to bring up inflation and how it drives mortgage rates, right? So here in this slide, you can see that inflation is here in this pink line, and inflation is relatively low in January 2018, and they check this financial picture every 6 months, right? So you can see that it's low, and that's a good thing. Now I want you to look at the 30-year fixed mortgage rate, right? So the mortgage rate that people will purchase a home at starting, let's see here, starting January, when did the pandemic happen? March. So you can see here that there was a little bit of recession starting even before the pandemic. But by the time the pandemic hits, you're at a little under 4%. By January 2021, you're at what, under 3%, under 2%, above 2%, but under 3%. So that's where we were. And people at that time were buying houses like crazy because it's like, whoa, this is free money, right? I can go out and buy a home and only have a 2% interest on my home, 2.5% interest, or maybe buy a second home at 2.5%, 3%, right? So you see that interest rates are very low, and the Fed did that on purpose to put money into the economy. But what happens to inflation? By July of 2021, what's starting to happen to inflation? It's rising. And it continues to rise to the point where it's well over 6.5%. It starts to come down because the Fed is now starting March. The Fed starts to what? Increase. What are they increasing? Put it in the chat area, just so I know you're still alive and and interested. What is the Fed increasing at this point in time? Interest rates, exactly. And as interest rates begin to rise, what happens to inflation? You see inflation's right here. What happens to inflation when interest rates start to rise? I'm looking at the chat. It goes down, exactly. And so you can start to see that there's a relationship there between inflation and interest rates. And that's a good thing for us to note as housing professionals. So I'm going to show you a couple more as we go on. That'll give you an idea of how to read these charts. So here you can see there was a little recession that was happening. Remember we had 2020, that would have been the start of a new administration. And there was a little bit of uncertainty just in general. So there was a little bit of a recession that was going to happen anyway. But then the pandemic happened, and that changes things. So you got the little recession that started there. And then down here, you've got inflation, pandemic, 30-year fix. And then you can see this relationship. This next one, let's look at the average 30-year rate. As I said before, you have high inflation in the 70s, right? Inflation is high. But look at the mortgage rates. 16.63% in 1981. Highest on record compared to the other years. So the 90s, we're looking at this, high sixes, low eights, somewhere in between there. And then, of course, you've got the boom of the early 2000s, right? You see the interest rates are fairly low. I mean, nothing. The pandemic is a very unique period in time. It's an outlier. You're not going to see that necessarily where the market is going to go as low as 2.9%, right? Traditionally, we like to be within the 5 and 7, somewhere in there. And that's considered a healthy economy. 2000, let's see, what else do I want to point out? Of course, you've got 2020, it's at 3%. By 2021, it's at 2.9%. And so, 2022, they start messing, the Fed starts messing with the interest rates, and it's going back up. So understanding headlines, now you have a better idea of understanding what's going on with the headlines. And you're always going to have people in two different camps. One that says, nothing's wrong with the housing market. It's perfectly fine. Leave it alone. And you have another person at the table saying, fire burning, the housing market's on fire, and there's going to be another downturn. So what's the right answer? When we're working with our clients, we want to provide them with, accurate information. And we're, by trade, we're not economists. There's a lot of factors that they're looking at when they make these predictions. And so we're not here to be speculative and make assumptions about the market. I think it's just best to give them facts and say, in general, like, for example, if somebody wanted to say, should I buy a home? I can show this chart and I can say, well, look, people were purchasing homes when they were 16%, and people were purchasing homes when it was less. For you have to, it's a personal decision, and it's based on your finances. So we have to look at specifics and leave it at that. But in terms of what you'll see out there, 1981 was like the worst year ever in terms of um, the mortgage rate itself. How bad is bad? 16.63%. So and this is what I mean by looking at it from a factual perspective. At 16.63%, a $200,000 mortgage is going to cost you $2,800. That same mortgage is basically costing you $1,300 more a month or $15,000 per year. So when we talk about today and how high interest rates are, you can show them that, of course, now you're paying more for that money over time, but that in the case of native housing, the need remains. So it's not going to be just that one factor. A single family home, that person on the reservation who's not going to move, it may make more financial sense for them to own a home than it does to rent. And NAHASDA itself, we can talk about the funding there and the fact that it was stagnant for so long. Of course, with 2020, it has increased because there was just so much more need that we were trying to address in terms of the pandemic and the effects that the pandemic has had on Native communities, in that it was so much more aggressive than in other communities as a global health crisis itself. But let's look at it from the fact that Congress appropriated $592,000 for the Native American Housing Block Grant in 1992. In 2022, Congress appropriated $1.2 billion for NAHASDA. That is large, and I'm thankful that that is the case. However, if they were even trying to match for inflation, remember what we talked about inflation and what it does to the value of a dollar, right? So, for example, if they were trying to match the $620 million that was given in 2000, that'd be over $1 trillion today. So this number should be much higher than it is. In the 26 years that NAHASDA's been here, it's been had a huge impact on homeownership in Native communities. I also think that the value of Native CDFIs and them investing in our communities. I'll talk a little bit about CDFIs in future slides, but know that I'm not dismissing these other elements. It's just there's so much to talk about when it comes to housing. 2021, we saw that their rates plummeted, right? Interest rates were low. So there you can see the economic sense it makes, right? At 2.65%, the monthly cost for a home is $806. That's huge. You'd save over $662 a month compared to those folks in the 80s. However, things are going up and they continue to rise. So the question is, when people ask how's the housing market, I say it depends. It depends on where you live. Depends on what communities you serve. Your proximity to certain supply chains, right? So there's a lot to consider. As we embark on the second half of 2023, there's certain signals that we need to look at. There's ways that we can pay attention to trends, but at the end of the day, there's a lot of mixed signals. So how do you help your clients? Well, the first step is staying informed. As I said before, this resource guide is here, and it's got all the different links that I use to kind of gather the data that we talked about today. So the National Association of Realtors was a big one. It gives you the housing statistics and real estate market trends. Certainly FRED, which is the Federal Reserve, they have an economic data portal, and there's a couple different ones. Fraser is another one. Alfred is another one. There's a few. Also, I think so the National Association of Home Builders, they have this homeinnovation.com, and they report on trends and reports. I talked about NAR a little bit, and then also the Fed. I don't have on here. I'll put it, but I definitely think the Native CDFI network and some others are important as well. So when you Google, has anyone used Google Trends? When you use Google Trends, like it shows you what people are Googling, right? And it's like, should I buy a home? How high is inflation? How high are interest rates? Let's talk about the lack of inventory, the lack of qualified housing professionals, construction in particular, right? Everybody had an uncle that could fix something back in the day. Nowadays, finding a qualified construction housing professional is tough. And if you're in a high let's say you're in South Florida, for example, where there's hurricanes, or you're, in California where there's, fires, in South Dakota, there's these extreme weather conditions that can also put a strain on housing professionals from the standpoint of having insurance claims, right? So what are we going to do about that? Because the emphasis on construction housing is huge. By tracking trends, this is how we can find out more about the housing market itself. So first, interest rates. I definitely think unemployment is important. Income growth is important. Housing supply, we talked about that. Economic growth, and that population growth itself, we talked about that. Birth rates, that's something we haven't talked about, but I'm going to show you a few slides that will help. And then, of course, we saw how government policies impact us as well, whether that's, the past with redlining, or the future and the interest rates and the Fed, right? So as you saw in previous slides, of course, median sale prices of homes have increased, and that's a good thing. Let me make sure I got my notes. So when people ask, when to buy, when to refinance. When to refinance is huge. We talk about generational wealth. We talked about real estate building generational wealth. Part of that is knowing when to sell. Part of that is knowing, when to refinance. If you had a 7% interest rate and now interest rates are at 4%, then it's a good time to refinance. But what if you didn't prepare for that as a homeowner? This is why I think a secondary, we talk about pre-purchase, but post-purchase, there should be a whole nother element to our post-purchase discussion where we're talking about refinancing. Sometimes refinancing out of Section 184 and into something that's more competitive, right? Because interest rates might be lower. Not now necessarily, but over time. Forecasted age. This is another trend that we can look at. Especially for those of you who are in community development, think about it from your production standpoint, the houses that you're putting on the market or that you're building, and the elements that'll be needed. So this is the number of people with over the age of 75 within the population. And of course, this is the average of the total US, right, in millions. So here you can see that as of 2016, they had about a little over 20 million, people that were over the age of 75. As you can see, what's forecasted here says that by let's use something more closer to where we are today. By 2030, that number will be well over 9%. So that's huge. What type of housing are they going to need, right? If this number is going to increase, multi-generational houses have increased. We always had those on the reservation, but now with the cost of living across the country increasing, you're seeing many more houses that are both child, parent, grandchild in the household. But they're going to need what? Stepless ranches. They're going to need, flat, no steps, right? Things like that. Maybe they'll need some accessibility built into the home. And if the cost of construction continues to rise, it might be a good idea to put those elements into the home now. Let's look at median age of home buyers between 1980 and 2021. So here you can see that in 1981, the average age of a homeowner, first-time homebuyer, was 29 years old. The person who was going to, purchase a new home, like they bought their first home and now they're moving. What's the difference between 29 and 36? Babies, right? Maybe they got a job change, job promotion, and now they got to move, right? So between 29 and 36, you're seeing they're needing to move because they need a bigger house, right? They need to move because they got a new job. So this second home, like needing to purchase that new home, starts here at 36. What about today, or in 2021? The average median age of a homeowner, 33. So much older, not terribly, but much older in that regard. What about here? That's a huge difference, 33, 56, right? So what's happening here? Repeat buyers, they're saying to themselves, I've stayed in the same job this entire time, and now what? I'm just gonna stay in the same home because the value of my home has increased to the point where I don't want to move until I'm ready to retire. right? So this is where they're like downsizing. So that's huge. Affordability affected their ability to buy another home. So they decided to just stay where they're at. If you're wanting some people are visual learners, so this is the year over change in terms of the housing price growth. And you can see, obviously, this was 2007 to 2012, where there was like this the downturn in the market itself, and housing prices. But then, of course, it returned. And then, of course, in 2020, those prices skyrocketed to where they are today. Okay, so this dotted line here, right, that's population growth. And it's interesting when you look at population growth and you look at the number of homes that are being produced, right, in general, just how many new houses, how many permits are being pulled. That's kind of how they calculate this. And when they look at new permits, they can see that it never really kept up after 2007. It never kept up with what was going on with growth, right? So what does that mean? That's why housing supply is so low, because builders who went bust in 2009 never came back. They've got new jobs and they do new things. Maybe they do construction remodeling on a low key basis, but they're not doing it in mass production anymore. They lost so much during the pandemic. During the Great Recession. So that's a huge indicator for me that supply is very low. People ask, is it going to be like 2008? Well, in 2008, we had tons of homes in the economy. There was, every other house was for sale. We don't have that issue now. So that's an interesting trend or indicator. Number of new homes constructed below 1,400 square feet. This is a big one because in the 80s, 90s, 2000s, it was like the bigger the better, right? The bigger the home, that's what we wanted. So you start to see a decline in these smaller homes, row homes availability. But the smaller the home, the smaller the cost, right? So a starter home, in the 1990s, early 2000s, is going to cost you $150,000. Now a starter home is going to cost you what? 250, 300. That's a lot. Construction spending. So we talked a little bit about how employment affects affordability, but specifically housing. Let's talk about construction. So this is how much construction companies spend on the cost of construction itself. So construction spending is in green, right? Construction employment is right here. This is in orange. And it shows that there's always a gap between how much they have to spend and how much they have to employ in terms of the number of new workers. So 1 billion in additional construction spending creates 3,600 new jobs. Going back to the economy and how you create a market, the housing market needs to have qualified housing construction professionals. But look at the discord between the number of professionals that came back after the 2007 recession. So the Great Recession had a huge impact on construction. And now there's this big gap between, where we are today and what we need in terms of workers. So going back to how this can benefit you as you develop programs within your community, construction is one of those programs where workforce development would be super important. Average sale prices of new homes. We talked about it from a couple of different perspectives, but for the purpose of this one, you can see here that there's still an unknown. We don't know whether or not prices are going to continue to rise. Sellers have to understand that there aren't as many buyers. That takes time. In 2020, 2021, they saw their neighbors put their houses up for sale and get top dollar and have 20, 30, applicants, offers on the table. Today, they don't have nearly as many. There's another statistic called days on market, and it's essentially the number of days that if I put a house on the market today, it's the number of days it stays on the market. Days on market during the pandemic, I'm talking 2-3 days tops. There were just so many buyers compared to sellers. Today, days on market are 30, 40, 50 days. So it is taking much longer to sell a home than it had been in the last 3 years. So what does that mean? When I talk to a seller, it may take, they may have to see it for themselves. I can put it at whatever list price they suggest, even though I know better, because they'll have to see for themselves after 2-3 weeks when they don't see any showings. Then I can have a conversation that says, this is where I really think we should be in terms of how much to list the home for. But that takes time. So when will we see prices decrease? I think they'll decrease a little bit, but again, supply isn't there either, right? We saw in the earlier slide that construction hasn't kept up with population growth. Talking about population growth, we have to talk about birth rates. So in 1985, 58% of home buyers had children under the age of 18. According to the National Association of Realtors, this percentage has fallen to 33% as of today, right? So we all know birth rates, and from going from a family of, even in my own family, from a family of 5 with my mom and my dad to a family of 2, myself, and I don't think I'm having any more. You can see that the perception of how much home I need has changed. So there aren't any smaller homes because they weren't building those, right? They've got these big, huge houses now that I can't afford. And here I only need maybe 3 bedrooms max. But if you look at birth rates, and over here, this chart shows you from 2006 that there was pretty much a negative birth rate. It got even worse in the early 10s, right? But yeah, the U.S. birth rate was fairly low, or below the global average. But then what happened after the pandemic? Well, even before the pandemic, it gets higher, right? It starts to grow. And so that's a good thing. What I would argue is pandemic babies, what is that? 30 years, what is that? 2053? Let's see how many people are in the market for a home when these people turn 33, right? You're going to see a group of people, not as big as the greatest generation or anything like, excuse me, not the greatest generation, the baby boomers, not as big as the baby boomers, but you're going to see that the need for home ownership and a disconnect unless we ramp up housing and the construction of housing, because these individuals are going to turn 33 in the year 2053. Excuse me, 30. So let's see here. In summary, what can we do? Well, one, we should understand the market. As I said before, I worked in Native housing and education in particular, working with spending, savings, credit, working, just explaining the elements to home ownership for years, and I never understood the market until more recently. Understanding the cost associated with housing will help, because we need to talk about the why more, talk about saving and generational wealth. As I said, homeowners have to save more. They have to worry about the cost of replacing roofs. What is the average cost or the useful life? How long does it take before a water heater goes out? How long does it take before I need to replace my roof? These things will matter as well. One time I was on a webinar and somebody said, "Oh, there's no like the value of my home on the reservation, doesn't exist." Typically on the reservation, we're using what's called the cost approach. How much did it cost to build it? Then it has a value. Just the fact that it's on tribal trust doesn't change the fact that there's value there. And I think we have to change those perceptions so that we can have homeowners who value maintaining their home and can adjust, right? How many of our homeowners took advantage of that 2%? I can tell you that in a non-native community, I can certainly see where individuals were savvy enough to say, wow, 2%, that's going to save me money. A lot of our clients had no idea that they could have refinanced and made their payments even lower than they are today, right? So that's huge. Knowing when to refinance creates that generational wealth. And if they don't know these things, then, I think that as housing professionals, these are the types of things we can bring to the table. And then lastly, it's always changing. As I said, there's always going to be people on either side of the table. And you're that sound voice. You're the one that's going to be able to say, regardless of interest rates. Let's talk about what your housing needs are. Let's talk about what the payments will look like. Sure, we need to do that. But also, historically, what will having money in your other pocket mean, right? Creating that equity, creating that wealth. What will that do for your family over time? So I think that in that way they can make better financial decisions. So at this point, I'll open it up for any questions. I didn't really leave too many question opportunities out there. So if you want, go ahead and put those in the chat area. I'd be happy to answer. Tomorrow, we're going to talk about home buying as a process, both on trust and off reservation. So that's going to really break down, debt to income and how debt affects affordability, for sure. I saw another percentage, and I'll look it up for tomorrow's class, but it's essentially that during the pandemic we saved, and that was great. But now people, between inflation and using their credit cards, credit card debt has increased tremendously between 2021 and 2023. So that's going to really affect people in the long run. With that, if there are no questions, I can go ahead and send it back over to Alyssa.
Thank you so much, Marie. You did an amazing job. Thank you so much for today's presentation. I greatly appreciate you for being able to take the time to do so.
Thank you.
Of course. I'm going to go ahead and launch the survey for everybody. The survey helps Marie and I know what you guys would like to see, and especially please let us know if there's anything specific you would like to know tomorrow, any questions you have. You can include that in the feedback, and I'll make sure that Marie gets that prior to her presentation. This just helps us in many, many ways, so we appreciate all that you can tell. Our next webinar is tomorrow, May 25th at 2 p.m. Eastern, 1 p.m. Central, 12 p.m. Mountain, and 11 a.m. Pacific. As always, registration is free, and tomorrow we are doing home ownership, buying your home 101. And of course, it's going to be presented by Marie Bonville, home ownership training technical assistant specialist of Sunlight Armor and Homes. Feel free to access this and any other recorded webinars online on our website at www.nativelearningcenter.com. We have a Cathedral Webinars tab and a recorded webinar section. You can click on any one of the webinars that we have done for the past 18 months. Feel free to view them and share them with your friends and colleagues. Check out our upcoming events as well on our social media sites such as Facebook, Instagram, Twitter, and LinkedIn. We even have a podcast titled Hopathanga Native American Podcast. You can find that on Simplecast, Google Podcasts, Spotify, and Apple Podcasts. Once again, I want to thank everybody for joining today's webinar, and thank you, Marie, for presenting today's webinar. You did an amazing job, and I hope everybody has a wonderful day.